unemployment will continue to rise. We're going to have out-of-control consumer debt, which is going to lead to an inability for the consumer to pay. Um, Families will start making personal decisions, business decisions, as in, do they want to put food on their table or do they want to pay their creditors? These are going to be moral dilemmas that families are having. Um, Commercial offices are going to continue growing in defaults, declining property values, vanishing equity, increasing adjustable rate loans, and resetting and recasting mortgages. Basically, the option arms and negative amortization loans are going to be the next wave, which I'll show you right now. What we're looking at is a graph of everything here in this gray section are the subprime loans, and as you can tell, this was from January 2007, so we are past this point now. Basically, we're into this section here where there really isn't much left to come with subprime loans, so we've kind of seen that wave ride itself out, and these are the last few that will trickle through the foreclosure process. But what we do have on the horizon is this right here, which if you look right there, that is the option arm, and those are going to start resetting about this time, and as you can tell, it grows substantially, and we don't even hit the peak of this until near the end of 2010. So we got a long way to go here. So what are the solutions? What can we do? Well, we believe that our software company has developed a very highly and effective solution. We've created a software application that is a modification analyzing platform, very similar to current lending information. However, it is in greater detail and depth. So what exactly is the map? Well, it's a streamlined software solution. It's very similar to what has been used for loan approvals for probably, I'd say, about the last 8 years. Fannie Mae's automated underwriting system that you input a borrower's information, and it tells you if that person is a qualified candidate for the loan. Based on the information, then you then need to document the information that was put into the system. Well, ours is that type of system as well. However, it's an automated loss mitigation evaluation system. So how does it work exactly? Well, you ask the questions, you input the answers, and that's essentially the gist of it. Our program is very unique to the market in the fact that we look at real debt and obligations of current borrowers. Where's the income going? Well, we really need to know where they're spending their money on a monthly basis. Other than the mortgage payment, where is money going? And just all the different options of where it could be going. Is it contributions to charities, college, religious, retirement, entertainment expenses, how much they spend on gifts, lawn care, maintenance, keep up of the house, gas, utilities, cable, internet, water, trash, life insurance policies, disability insurance policies, health insurance policies, you name it. I mean, none of these factors were ever taken into consideration when giving somebody an initial loan. So they need to be looked at. So based on all that information and based on the position that the borrower is in, are they a candidate for a modification? That has to be the first question that's answered. Some people are true candidates. They're living paycheck to paycheck. They're upside down every month by a few $100s. They are upside down on their house. They don't have anything in retirement. They don't have any assets. And so all these factors combined, they qualify for a candidate. Um, some people just need to really evaluate their budget and see where they're spending their money, where their money's going, and get a budget plan in place. Doesn't necessarily mean that they're a candidate for a modification. Uh, and then we have the individuals who truly just they don't qualify for a modification just because they can't refinance their home because it's not valued at where they thought it was. If they can still make their bills every month, that is not that's not a candidate for a modification. So the question is, if they are an approvable candidate, do they qualify to modify? Well, um, our program looks at the Obama administration guidelines of the Home Affordability Program. It also looks at the FDIC's instituted guidelines and basically says, based on those guidelines, yes or no, this is a qualified person for a modification. However, we also show based on our own inputs because those two programs don't take into account everything that was mentioned before. And that is a major reason as to why we're seeing 70% redefault rates, because people are not getting their mortgages modified to an actual sustainable affordability payment level. So our guidelines may tell you that this person does not qualify for a modification, and the best interest of the lender is going to be to have them contact a lawyer and look to get the house on the market, probably in a short sale type of situation, and but get moving on it today, other than going into foreclosure. So if those are the input options that come out prior to making that decision, you can go in, whoever is looking at the review with this borrower, or the lending company that's reviewing this has the ability to go in and really evaluate their debts and say, hey, this person here, that they're spending $197 on home maintenance, which is actually making up nearly 3.7% of their gross household income. That's kind of absurd, and we don't need to take the hit of $197 because they don't want to mow their own lawn. So in that case, our software gives you the ability to come in and just click the little checkbox next to it, omit that payment out, and put that payment back towards the existing mortgage so that it's qualifying based on that additional income. So as you can see here, this is a quick summary breakdown of the numbers that were illustrated from this particular borrower scenario. The foreclosure look to short sale option was what initially came through, because what we were seeing is that the lender would actually be better off by $5,000, almost $5,700, going through a foreclosure rather than modifying to what the existing budget was going to require. Their existing budget was going to require them to go down to a 1.6% interest rate on a near 40-year term, bringing the payment down to $1,194, which was really just unaffordable. That would have been a savings of $403. However, that's not going to be the most financially beneficial situation for the lender, which in the end, that's what all this comes down to. How are the lenders going to benefit? Because these aren't feel-good stories and just trying to help people out. These are business decisions, and it really is about the money that's being made. So we show them true numbers so that they can make educated financial decisions on, hey, do we want to help this person out and still keep our profitability up, or do we want to go ahead and move forward with the process? And then with that being said, just take the loss that we're going to take through the foreclosure itself. If we can eliminate some of these debts,